What's up YouTube, Tim Layton here, and welcome back to my YouTube channel. Now today is the day that some of you have been waiting for. Today I'm going to start breaking down what options trading is. This will be a 3-part series. Today is going to be part 1, and that's just going to be an easy, simple breakdown of the basics of options trading. Part 2 will be the more in-depth metrics and sciences behind options. And part 3 will be all of the different strategies you can utilize in options trading. So today's, like I said, going to be a simple breakdown to ease you into options trading. Without further ado, let's get right into it. Alright guys, so jumping right into it, what is a stock option? Now we're going to go over the definition of an option, as well as the definition of a few key terms that you need to know before you start buying options. So first, what is an option? A stock option gives an investor the right, but not the obligation, to buy or sell a stock at an agreed upon price on an agreed upon date. Alright guys, so the first term that we need to know when talking about options is a call option. Now simply put, a call option is a bet that the stock is going to rise in value. Now this next part's important. This next part only applies if your bet came true. So if your bet came true and the stock rose to whatever price you thought it was going to rise to, you now have the right, but not the obligation. In other words, you have the opportunity to buy 100 shares of that stock for whatever price you bet it was going to go to. So real quick, let's say you had a $100 stock. You bet that it was going to go to $101. It shot up to $150. Well, your bet was correct. It did shoot up to at least $101, meaning you can now buy 100 shares of this stock for $101, even though that stock is now worth $150, meaning you have an instant profit of $49 per share, and you have 100 shares. Now the next term we need to know is a put option. Simply put, see what I did there? A put option is a bet that a stock's value is going to go down. And again, this next part is very important. It only applies if your bet comes true. You have the right to sell 100 shares of a stock for whatever price you bet it was going to fall to. So let's say you have that $100 stock. You bet that it's going to fall to $99. Now that stock plummets to $50. It tanks. Well now, because your bet came true, you have the opportunity to scoop up 100 shares for $50 a share and turn them right around and sell them for $99 a share. Okay, now the next term that you need to be familiar with is the strike price. Now all the strike price is the price that you think the stock is going to reach. Again, for calls, it is the price that you think the stock is going to rise to, and for puts, it is the price that you think the stock is going to fall to. Now, when it comes to strike prices, you get to choose your own strike price, and you have 3 options when it comes to strike prices. You have in the money, at the money, and out of the money. First, you have in the money. Now, all that means is that the stock price has already surpassed your strike price. So, for example, if you buy a call on a $100 stock, you can set it to a strike price of $90, meaning you think that this $100 stock is going to surpass $90. Now that already happened. $100 is already past $90, making that strike price in the money. Now what that does is lower your risk. Because if you remember, you can only execute your option and buy your 100 shares or sell your 100 shares if your bet comes true. So by buying an option with a strike price that has already came true, you lower your risk of your bet not coming true and you losing all of the money that you put in. Now the second option is at the money. Now that's kind of self-explanatory. All it means is that the strike price and the share price are the same. So if you were buying a call on a $100 stock, you would buy a strike price of $100. Now that's medium risk, because the stock could potentially fall to $99, and now your strike price is out of the money. But at the money strike prices are pretty safe, because all the stock has to do is either stay the same or raise in price, and you get to execute your option. Now the third option is out of the money strike prices. Again, we're going to use calls as an example. You have a $100 stock, and you make a bet that this stock is going to rise to $110. Now that's a pretty high risk play, because you have no idea what the stock is going to do. And you're betting that the stock is going to rise 10%, and it very well could not. So it is a high risk play, but it's also a high reward play, and we're going to get into that later. But those are your three options for different strike prices. All right, now the next term you need to be familiar with is the expiration date. Now you get to choose this date as far out as you want, and it is the last day you have for your bet to come true and for you to exercise your option and buy or sell your 100 shares of that stock. Now it's very important to choose the right date, because you want to give yourself enough time for your bet to come true. All right, now the last term that you need to know before I show you guys some examples is the premium. Now what the premium is the price that you got to pay to make your bet, the money you put on the line. You can't make bets for free. You got to buy the contract, and that is the premium. Now how you get the premium, how the price of the contract is determined, is super complicated, and we're going to get into that in the next video. But for now, the way I look at it simply is it's driven off of the last two terms that I used, the expiration date and the strike price, which essentially turns into your chance of profit. So your chance of profit determines the premium you pay for the contract. If you buy a call and the strike price is in the money and it's a super low risk bet, you're going to pay more for that contract. But if you buy a contract, you buy a call that is way out of the money, a $100 stock, and you buy a $150 call, the odds of you making your money back are super slim. So that options contract is going to be significantly cheaper. And then you have your expiration date. If you give yourself 1 week for this bet to come true, the chance of that bet coming true is very slim. So that option is going to be very cheap. Now, if you give yourself 3 years for that bet to come true, your expiration date is 3 years out, the odds that bet is going to come true are pretty high. So that option is going to be super expensive. The higher your chance of profit, the more expensive the premium is going to be. And the lower your chance of profit, the lower that premium is going to be. All right, now real quick, I'm going to pull out my phone and I'm going to walk you guys through how I would have played one call and one put to give you guys a little idea. So first up, I got NEO right here. If you watched my video last Thursday, you will know that I said that NEO was extremely undervalued. I think at the time of that video it was at 20 bucks. It dropped as low as $19. So if you would have watched my video and took my advice, on Friday morning, you could have bought a call while NEO was at $19.47. Now what I would have done is buy a $20 call, just barely out of the money. And I would have given myself at least a month for it to get there. So I would have probably bought this call right here. See, the strike price is $20. The expiration date is March 4th. Now, on Friday, this option was worth $198. As of today, it is now worth $445, giving you a profit of 124%. And that goes to show NEO only rose 21%. And that goes to show the power of options. That's leveraging your money because you're controlling the outcome of 100 shares of NEO. So you turn a 21% stock profit into 100 and something percent. Now, if I was to buy a put, it would have been on Tesla. If you look 1 month ago, Tesla was at $1,149. Now, somebody like me, I thought Tesla was way too high. If I would have bought a put, I would have bought a $1,000 put on Tesla. I would have bought a $1,000 put because options on Tesla are super expensive. So I wouldn't have bought a $1,150 put. That would have been like $10,000. But this $1,000 put wasn't too expensive. On January 4th, it still would have been $10,000. Wow, that was expensive. So I probably wouldn't have done that. But now, as Tesla has fallen 21%, you could have made 73% profit. So those are two examples of some options that I would have bought. I didn't end up buying them because I actually have all my money tied up in other options right now. But those were two that I was looking at buying. I didn't end up buying them, but that just goes to show the profit that you can make if you do buy options and you play your cards right. Alright guys, so like I said, this video was a very simple introduction into options. I didn't go too crazy, didn't go too deep. Now if you already had a decent understanding of options, this video might have been pointless. But this video was for people who have no idea what options are. I'm trying to open their eyes to it. Again, I will be making a part 2. I don't know if I'll do that tomorrow or sometime next week, but I will be making a part 2 that's way more in-depth into options, and then also a part 3 talking about different option strategies. But for now, this was just a simple introduction. I hope whoever watched this video learned something, learned a little bit, got a little more comfortable with options. And if you liked what you saw today, please don't forget to like, comment, and subscribe. And stay tuned for part 2 and part 3. Thank you guys for watching.